Hi everyone. Can anyone hear me?
Hello.
Yes.
Yes.
Good morning.
Good morning.
Hello.
So thanks everyone to making yourself available for today's call. Given that it's a holiday, I hope I'm not, taking some critical time of yours.
Good morning, everyone. Good morning, Talgat.
Morning.
How are you?
I'm good, thanks. Thanks. Yourself?
Not bad, not bad.
Hello, Professor.
Thank you. Hello, guys. I hope you're all good. Happy Nowruz to everyone.
Thank you too.
Happy
And
Nowruz to everyone.
Thank you.
thank you so much. And sorry for this inconvenient time that we organized it. Unfortunately, there was no any available timing for this.
Yeah, sure, no problem on that. Yeah, happy to help. How much? By the way, when students are back to university after the holidays?
Actually, on Thursday.
Okay.
They'll be back. But we will meet on Saturday, so they have to prepare their project by Saturday. Yes.
Okay, great.
Okay. And I think the time will be more than enough. More than enough for it.
Yeah, in any case, Alimshan, I think if there would be any comments that some areas of today's calculations would be unclear to students, then I can assist with that. I can make another session say on Wednesday, for example, during the day, to answer questions of students if any of the areas would be unclear to them.
Yeah, it's very good idea. Let's make like this, Talgat, then. We can arrange 1 hour for Q&A.
Yeah.
Any time that is convenient to you. So all the students, they may have a question, they can just enter to this Zoom link and ask the question if they will have.
Okay, great.
So if you can share the free time of your, like which time is convenient to you, we can just distribute and announce it like this time, Wednesday, we'll be online. If somebody will have any questions, they will just get in and just ask the questions.
Yeah, great. So basically, guys, the calculations we will run through today, they're not, hugely complex. They're not difficult, to my understanding. In addition, you will have the Excel file, basically the spreadsheets where all the calculations have already been done. So I will run you through the example through one of the companies, so through one of local companies. And so everything should be in place. But if you will have questions, please feel free to ask. But nevertheless, if you will have questions, we can make another session on Wednesday. Okay.
And can I add one more thing here before we start? Guys, would it be possible for you to share now, tell in the WhatsApp group that class already started, to kind of give a reminding? Please, if it's possible, to just make an announcement that the class has started so that they can catch up us. And the video will be recorded and will be uploaded on Moodle, where you can have an access on it.
By the way, Alimshan, do they have an access to the video I did earlier during the autumn semester when I spoke about this?
No, they don't have it. They don't have it because every semester the Moodle is updated, is changed.
Okay.
But I have those videos, but still, will it be useful? I don't know. I think it's better to use the relevant one that you're going to prepare to that.
Sure.
Talgat, I think we can start. the others will catch up.
Okay, good. So, guys, I don't have any presentation today because this is a practical session, as we discussed earlier. I will try to show you how practitioners in Kazakhstan basically calculate the cost of capital. And actually, this is not only in Kazakhstan. I have worked with a team from South Africa, so they also use the same approach, the approaches that we will go through today. Okay. I will also discuss how to determine the optimal capital structure, the debt capacity of the business. It is also not a very difficult calculation, and normally for a company when you reach the maximum debt capacity of the business, this becomes the optimal capital structure for the business. But there are some special cases for that as well. So, but let's start. I hope that running through these exercises, firstly, you will get a better grasp of the theory that you have already studied. I also hope that you will have an application of the theories that you have studied, right? And you will experience the approaches that are being used by practitioners in Kazakhstan and actually globally when calculating cost of capital and doing other analysis for private companies. And most importantly, I hope that you will get a better understanding of risk, of what is risk in the context of corporate finance. Why I think this is important to understand that, because again, in the context of corporate finance, every decision that is being made, that the practitioners make, this is associated with the relevant risk of that particular project. So investors are always looking looking to determine the risk, to calculate it correctly, and to they are looking to invest in assets that provide the best return adjusted for that risk that has been calculated. Okay, so in terms of the project, a quick note from me. I'm not sure if this already has been transferred to you, but you will be distributed into groups. There are 4 persons within each group, and you will have each group will have one company. This is the local Kazakh company incorporated in Kazakhstan, and you will need to do the analysis. And I will, after this session, hopefully today, I will. There are 12 groups as far as I know, and I will let you know the names of the companies. It is we will be assigning companies that are that have information on them, that where the financial statements are available publicly through the internet. Okay, so I've put in some notes over here just to guide me through what I would like to say. Let me give you some perspective on stuff that we will be talking about today. You all know that the key objective of corporate finance is to maximize the firm value. Basically, to maximize the firm value, you need to pick the right projects. Okay, but in order to, because these projects, they will maximize the firm value. But in order to pick the right projects, you need to understand the risk that is associated with that particular project. Okay, and so you need to be able to calculate that. Therefore, the cost of capital is very important in this context, in the context of corporate finance in general, because the cost of capital is a measure of risk. Okay, So what else I wanted to say? So, you know, when you invest somewhere, every, you know, asset has its own risk. When you invest into risky assets, for example, if you invest in a startup, it will have a higher risk. So I'm, you know, I think it's very important that you understand the perspective, that you understand that when you invest into a risky businesses, into a risky ventures, the cost of capital will be higher. So startups, because they are you know, the management could be inexperienced in a startups, because the business processes are not still set in the business, because there are many obstacles that, you know, business owners never envisioned. You know, the risks of that project of investing in the startup will be higher. On the other hand, if you invest in say a mature company, large mature company, then the risks will be lower, obviously. So the cost of capital will be lower. Again, because, you know, the business processes are already in place, management is experienced, and, you know, there are less uncertainties about the operations, generally operations of that business. So you need to understand this sort of stuff. Also, for example, you know, when you invest in debt, it is less risky than investing in equity, because, you know, during the liquidation of a company, you know, the debt holders will get their repayments earlier than the equity holders. Okay, therefore there are less risk when you hold you know, bonds. Okay, so let me share my screen, and I think we can start our discussions. So share that. Do you see my screen?
Yes, we see.
Okay, thanks. So let me start from, you know, looking to the formulas. Okay, so I have seen, this is your lecture notes, right? That you run through with Alimshan. And let me start from WACC, right? So this is what we will be calculating. So this is the weighted average cost of capital. So you can see that we have the weights here, the cost of debt over here. We have the cost of capital, sorry, cost of equity over here. And then we have the cost of preferred stock. Normally, basically in Kazakhstan, 95% of time when you will come across companies, they wouldn't have preferred stock on their balance sheets. Therefore, I will only focus on the cost of debt and cost of equity. Okay. Nevertheless, in your lecture notes, I've seen that you actually studied how to calculate the cost of preferred stock, so you should be fine with that. Okay, then what else I would like to note is that, well, let me start from the cost of equity. Okay, so there are the formula that you have studied on the cost of capital. You use basically the model, the risk and return model called capital asset pricing model, which is, let me find the formula on that. I've seen it somewhere here. Yeah, here is it. So this is the formula that you have studied, right? I'm not going to run through it, but so what I would like to say, the capital asset pricing model is the oldest risk and return model that, you know, we have today. But there are other different models. There are, you know, arbitrage pricing model. There are, you know, multi-factor model. There are proxy models. And practitioners, they actually use the combination of all these models, or they use an extension of the capital asset pricing model. And I will show you how these models will look like. So here is the formulas. Here is the formulas that practitioners use today. So one of I've seen as all these three models being used by different organizations. The big four companies use one of those models. Different big four companies. Deloitte uses one. I think Deloitte uses the last one. PwC uses the first one, for example. Our Samruk people in Samruk Kazina, they use the mix of all those models. And people from other countries, I've seen them using this model, for example, in the middle. So this is just a combination of all those three, and there is a logic behind this usage, and I can explain that if you would like me to, but I wouldn't focus on that now. Before we continue with our calculations, I think it is worth to run through every component of calculating the cost of equity. Basically, in order to calculate the cost of equity, in general you need two components. So this is risk-free rate and the risk premium. So here we have the risk-free, okay, and the premium is that one. So the premium, when you invest into a risky asset, investors will require the premium for that risk. So they will demand a higher return for every additional risk, okay? And so these latter components of the cost of equity is there to explain an additional risk that investor is exposed to, okay? And please, guys, feel free to stop me any point where you feel something is unclear, okay? So I understand what is risk-free. Risk-free is when basically, mathematically speaking, is when your expected returns is equal to your actual returns, okay? So it means that the volatility, the standard deviation is zero. So if you, for example, expect to get 10% out of 100 tenge investment, then you will get that at the end of your period. You will get that 10 tenge of your returns, okay? Right. So normally when you look into a country, the entity that is assumed to have no risk, which is default free risk, is the government, because government has the lowest probability of defaulting when you're looking into a country, okay? Therefore, it is assumed that the government bonds, for example, are risk-free. They are not, in fact, especially in Kazakhstan, but it is at least a good approximation. And guys, you need to understand, when you are calculating cost of capital, it is impossible to correct very precisely the cost of capital. Everything you do is just an approximation. So you need to be content with that this is just an approximation, okay? So the next factor that is important is the equity risk premium. So this is the risk investing into any particular market. So we have the market risk premium over here, as you can see, right? So this is basically the equity risk premium. When you invest into a company, it means you investing into in the equity of that company, and you know, companies. Well, it means that you're taking additional risk of investing into that company. Therefore, investors demand compensation for that risk, and therefore, you know, you have to include that risk into your calculations. Then we have beta over here. What is beta? Beta is, you know, when you invest, basically, if you have these two components, the risk-free rate and the equity risk premium or the market risk premium, this is it basically. When you invest generally into a country, for example. But, you know, the market risk premium or equity risk premium, this is the average risk of investing into all the industries of this particular market. But when you are looking into a particular industry, for example, when you are looking into, say, manufacturing sector, when you are looking into infrastructure, the risks could be different compared to the average risk. So your industry may be as twice risky as your average risk. Okay, therefore we have the beta to, you know, to factor in that differences. Okay, when you invest, for example, into a very you know, secure, you know, industries, you know, commodity industries, for example, I mean, you know, maybe you know, retail industries, your risk profile will be different. Therefore, you know, you can be investing into an industry that is twice you know, less risky than your average market risk. Therefore, to account for that, you have the beta factor over here. Then we have the country risk premium. So what is country risk premium? When we calculate, when we would like to know the equity risk premium of investing into Kazakhstan, you will quickly, you know, understand that there is very little information on the capital, on the, you know, equity capital markets, where, you know, normally all the information come from. And because of this lack of information on Kazakhstan, it is very difficult to calculate the equity risk premium. And therefore, normally what we do, we take the equity risk premium on basically the US equity risk premium. This is the risk premium of investing into the mature markets. And we add the country risk premium, obviously, because, you know, investing into Kazakhstan is more risky than investing into the, you know, developed world, into the with the developed you know, markets. So therefore there are, you know, this country risk premiums. Also we have the size risk premium. You know, finance scientists, they you know, analyzing the statistics, they found out that, you know, when you invest in smaller companies, you know, basically smaller companies, growth companies, they yield higher returns. So higher returns means that there are higher risks of investing in these companies, in these small companies, in these young companies. Therefore, investors demand compensation for that additional risk. Therefore, there are you know, a premium for investing into the you know, smaller companies. And there are, you know, company specific risks. It could be, you know, different sorts of you know, risks that, you know, an analyst feels appropriate to include. Okay, so this is the general composition of the, you know, of the cost of equity calculation. So let's start from our calculations. Basically, I have done 6 approaches. This is what I have prepared. I have updated that calculations, and I think today I will focus on the approaches from approach 1 to approach 4. This is just for your benefit, not to confuse you to many approaches. And I think, you know, the first 4 approaches will you know, provide all the necessary, you know, calculations for you to understand, you know, the essences of the, you know, relations of the meanings of the components of the cost of capital. Okay.
Excuse me, Talhat?
Yeah.
Hello. I have a question. Where do we include inflation, or do we take this factor later in the calculation?
Well, this is a good question, and we obviously have to include the inflation, you know, and I will show you how we do that, right? Basically what we do, we a lot of factors we take, a lot of factors we use, they are based on the US dollar data. Therefore, when we change the US dollar from USD to tenge, we take into account the inflation. Okay, and we will come to that in you know, in 5 to 10 minutes. Okay.
Okay, thank you.
So, you know, before we start with our calculations, another important point I think to make is that before you start your calculations, you need to understand what company you are analyzing. You know, what business, what the company, in what business it is in, what industries it works in what countries it operates, you know, what currencies, what is the operating currency, you know, whether the company, you know, have any, you know, export that, you know, provides some, you know, currency revenues, for example, because all these factors will affect the risk of the company. For example, you know, recently Oleg Tinkov said, well, you know, very recently, I've read that, you know, just a couple of days ago, he said that his bank, basically Tinkov Bank, is, you know, planning to enter the Kazakh market. And once, you know, they enter the Kazakh market, and once they, you know, earnings start to grow from the local Kazakh market, their risk profile will change. Okay, because Kazakhstan is another country, it has its own risk profile, right? It is, and you know, and our countries is different. For example, you know, investing in Russia is more risky today. It is more risky than investing in Kazakhstan, because you know, first of all, there are sanctions on Russia, and second of all, I think because, you know, historically Russia has defaulted once in 1998. You know, Kazakhstan has never defaulted, so it has quite good statistics. You know, so every country has its own profile, and likewise, every business, every industry, every market has its own profile, risk profile. So you need to understand where businesses operate, again, in what countries, in what industries, and what sort of business. Okay, this is first. So I took as an example company which is called RG Brands. RG Brands is a you know, is a beverage producer, soft drinks producer. It basically produces you know, brands. They produce tea. The brand is Piala. They produce milk, Mayo brand. They produce you know, soft drinks such as Pepsi, Mirinda, 7-Up, and you know, stuff like that. I'm sure you all know, you are all accustomed, well, I mean, came across this company. Okay, so it is very important to firstly to understand the company. So now let's start our calculations. let's look over here. So I'm starting with this model, with this approach. So our first component here is risk-free rate. So again, as I said, we can take, we assume that the government is risk-free. Okay, there are different approaches to that again, but let's focus on approach number one. In here, we took the euro bonds of Kazakhstan. So they are denominated in, so euro bonds, meaning they are denominated in US dollars. I mean, well, these euro bonds are denominated in US dollars. So I took the 10-year euro bonds. In fact, I would say that currently there are no 10-year bonds. Well, 1 second, let me do something over here. Let me move that. All right, so nowadays, so well, firstly, risk-free rate. We got risk-free at 1.76. Okay, so where we took that, we have it over here. So let's move to the source, to the source of that number. So this is where I took it from. So when you will be doing your project, you can also go through these links. You will be provided with this file, with this Excel file, and you will have this links to access. So let me show you. So at the time of my calculations, you can see here is the euro bonds we have. So this is the euro bonds in USD. This is the euro bonds in the euros, and here is the yields to maturity. Okay, but over here you can see the year of the end of its tenor, right? And normally in corporate finance, you have to pick the duration of your bonds need to match the duration of your cash flows normally. Why? Because the longer your cash flows of your project, for example, or of a company, the higher the risk, and therefore you need to match the risks. Okay, therefore you generally pick the bonds that with the same maturity year as your project cash flows. Today in Kazakhstan, well, another rule of thumb is to use the 10-year bonds because they assume to be optimal. They provide the longest duration, but if you go beyond the 10-year period, it is assumed that they don't. It is too far. In terms of the timing, it is too far, and therefore some of the risks might not be well accounted for. Therefore you normally take the 10-year bonds, but today we don't, in Kazakhstan we don't have euro bonds, 10-year euro bonds. But what I have done over here is that I basically calculated my the potential rate, the approximate rate for my 10-year bonds. So what I did is that I basically, we have the basically our yield for the bond that will be matured in year 44, and I subtracted from that 1.1 yield, which is the bond with the maturity in 2024. That gives me so that number 2.2% provides me the yield from 2024 to 2044. So 20-year bonds. starting from 2024. And what I have done over here is that I have divided that number by 20, so I know approximately the incremental, additional risk for every following year. Okay, I hope you understand me. So I basically, so I divided that number by 20. Over here, you can see I multiplied it then by 6 because, from 2020 to 2030, there are, well, 10 years, and to that yield, I have added, the remaining six years. I hope you got me. So this is how I calculated the approximate yield of my bond. So this goes to my risk-free rate. Okay. So this is the risk-free rate over here. Then next step is to get the equity risk premium. Okay. Again, as I noted earlier, it is quite difficult to calculate the equity risk premium for Kazakhstan. Therefore, normally what everyone do in the market, they just assume they take the equity risk premium that has been calculated for the mature market. Normally, this is the US market because they have the most amount of information on the market. And the most recent basically data says that the equity risk premium is at the level of 4.72%. And I took it from the Demodoran site website, and I think Demodoran does quite a good job in calculating equity risk premium. So let me go to the source. So here is the equity risk premium for Kazakhstan. Basically, it has been calculated. Basically, what we do is that we just take the equity risk premium for the US. You can see over here. See, equity risk premium, and it's 4.72. Here, I just basically calculated that. So this is the equity risk premium that the Demodoran calculated for Kazakhstan. This is minus country risk premium. Okay, and have anyone ever used the Demodoran website?
No.
Never, right?
No.
Okay. Well, for maybe some of you have already used that, some of you are not. It's very cool site, to my opinion, and it has all the latest information on the markets. So let me go on the website, I think, of the Demodoran, and I'll show you. So can you see my screen?
No, we cannot see you because you just shared your Excel spreadsheet. If you just reshare again everything,
right? Okay,
we'll be able to see it.
Okay, new share then. Right, 1 second. And it's a shame, guys, that I cannot see your faces. I mean, within the class environment, because it is very difficult to work with the energy and with the reflections on your faces. But I hope anyway it will work. So do you see now my browser?
Yes.
Yes.
Okay, great. So you just type Demodoran over here. So here is his website. So this is the guy, he just does it by himself, all this analysis. He's called the Dean of Valuation. So he is quite, experienced in valuation in corporate finance. So very, interesting personality. And what he does on annual basis he calculates equity risk premium. Actually, during the COVID recession, he calculated the cost of equity every day, if you can imagine, just to better understand how the COVID crisis affects the market. So now what you do basically is you go to data, as far as I remember. After that, you just go to the, so what we were looking for, we were looking for the cost of equity, right? So we just go to the risk rate, discount rate. Yeah, I think we go over here. And from here, we need to find the equity risk premium. Let me have a quick grasp. I forgot. Let me check something quickly. Right, okay. 1 second. Let's see, cash flow. Okay, I think this is over here. So the risk premium for other markets. Okay, so let's open that. Yeah, do you see my screen, right?
Yes.
Okay, so let's find Kazakhstan and see if this is correct. Yeah, this was correct, I think. Let's let me check something else. So levered, unlevered betas. Here is it, implied equity risk premium. So let me download that. Actually, let's download this one. Yeah, this is right. This is correct. So let me reshare my screen now. I think it needs to be done.
We can see your Excel.
Okay, great. So this is the file I've just downloaded. So as you can see, right? So going through into that directory on the Demoderan side, you can download this file, and you can see the equity risk premiums for different countries. And generally, how he calculates that, he calculates the equity risk premium for the US market, and then all the other markets are because the US market have the highest credit risk, right? Credit rating. Well, one of the highest credit ratings, and it is developed with the developed capital markets. It is assumed that it has the lowest risk. Therefore, all the other countries with the lower ratings will have additional, default spreads added to the equity risk premium. So therefore, for example, let's again find Kazakhstan. Where is that? Kazakhstan. Did I miss that already? No. So here is Kazakhstan. So see, he calculates that the equity risk premium for Kazakhstan is 6.85, but when you subtract 2.12, and this is the country risk premium, you will come to the US equity risk premium. Okay. And if you take any other country, for example, Cameroon, right? So you see that country risk premium is 5.33%. So when you subtract that from this number, you will get the equity risk premium of the US market. The equity risk premium of the US on this Excel file could be a little bit different, because I think he updated the Excel file very recently, and when I looked at this Excel file, it was about about a week or 2 weeks ago. numbers were a bit different. Okay, so it is also important to understand that, you know, markets change, everything is changing, therefore, you know, the risk premiums will, you know, dynamically change with the dynamics in the market. But nevertheless, let me open my my screen again. Okay. So this is the so this is the rates that we took. And when you will be doing your projects, you can do it yourself, and your equity risk premiums for the mature market could be different. Okay, so let's go back to our, you know, general calculation. So this is the equity risk premium, and I can assure you that all the practitioners use the equity risk premium calculated by other people. You know, it could be the Modern, it could be somewhere else. Then, as we discussed, you know, we look at the beta. Well, basically, I took the beta again from the Modern website. Let me go to the source. Where is the beta? Over here, right? So the source. This is from his website again. Let me show you. So. Do you see the screen? My browser?
No,
we see
only Excel.
No, yeah. Let me reshare that then. Okay. So again, this is the, you know, the screen that from the Modern website. So you can see it's written here: levered and unlevered betas by industry, right? And you can take that. You can go to the emerging market and download the betas from there. So let's open that. So here is the betas by industry. So every industry, as I explained before, will have a different, you know, different volatility, right, compared to the general average market volatility. Okay, so therefore, you know, our company is a beverage company, so you can see it over here. And so the beta that I took is that one, not 0.55. Okay. Another point to make is that normally when the industry professionals and when you normally do some corporate finance exercises for private companies, you calculate beta yourself. So most of the time, practitioners, they calculate betas themselves because they know which companies they would like to be compared to. So basically, how this beta, this particular beta, has been calculated by the Modern. So he took the betas of the market on average, and then he took a collection of beverage companies. So, you know, Coca-Cola, Sprite, you know, all those companies, you know, from different countries. And then he ran a number of regressions to understand how, you know, this particular market is different from the average market. And so the result is not 0.55. So what does it mean actually, beta, right? When you are using beta, don't just, you know, automatically use it. You need to be, you know, wise about it. You know, you need to understand when you, for example, invest in a cyclical market, it means that your beta will be higher. If your company, your particular market is, you know, behaving in the same way as the general market, your beta will be 1. Okay, if it will be, you know, more volatile, then it will be more than 1. If it will be less volatile, it will be less than 1. Okay. So when you invest in a cyclical industry, for example, it means that there are more volatility, which means that there are more risks. Therefore, your beta will be more than one. When you invest in, for example, premium goods company, like, jewelry company, Cartier, this sort of companies, also your beta will be higher. It will be more than one. If you invest in young companies, in growth companies, also your beta will be higher. Okay, when you invest in companies with high fixed costs, also your beta will be higher. For example, investing into oil sector in Kazakhstan is riskier than investing in the oil sector in Saudi Arabia. Why? Because there are in Kazakhstan the price of extracting of 1 barrel of oil is more costly than it is in Saudi Arabia. So you need to understand this sort of stuff when using every digit in your calculations. Right, so this is where we took for simplicity reasons, just for your benefit, just to get an understanding. I don't want to spend time on calculating the beta ourselves. Otherwise, what we normally do, we find the comparable companies from Bloomberg, and from Bloomberg we take betas of every company, and then we calculate the median of these betas ourselves. This is what we do normally when we do our analysis during our transactions. But today, for simplicity reasons, I took this I took the beta from the Demoderan website. Okay, let's go back to our calculations. Let me reshare the screen.
You don't need to reshare. We can see.
All right. Okay, great, perfect. So this is where I took it from. Okay, let's go back. I also found some, other betas, but I didn't use them. Basically, RG brands, they mostly work in Kazakhstan. They also have some sales in other Central Asian countries. They also trying to enter the Russian market, but I think, as far as I understand, the share of their sales in other countries is small. Therefore, I assumed that will only work in Kazakhstan. And I assumed that they mostly, deal with, beverages, because they also dealt with food, I think, but it also was, quite marginal in their, in their revenue. Therefore, again, for simplicity reasons, let's look at the, beta for beverages only. Okay. So this is our beta. But when you use beta, basically what happens when you have, as again I noted earlier, that when a company have a lot of debt, it means it becomes more volatile, because debt provides fixed outcomes, fixed payments. In good times, in bad times, your company will have to pay the debt. It will have to service its debt in good or bad times. Therefore, more debt you have, more the more money will go into serving this debt. Therefore, you will have less free cash flows. Therefore, you will become more volatile. Therefore, you need to incorporate that volatility into your beta. Therefore, basically, what you do here, over here, right? So here is the unlevered beta. So this is the every company in the sector has its own have different capital structures. So basically, when you calculate, when you take the industry beta, you take out this you know, capital structure effect. Have you guys, you know, run through that, you know, idea in your on your lectures?
Yes, we did it actually. It's levering and unlevering the data, the beta, and using the comparables to estimate the beta.
Okay, good. So
the slides, we had some formulas. Like first we unlevered and levered the beta.
Yeah. Well, yeah. Basically, when you get a compilation, a collection of companies to extract your beta from, all these companies will have different capital structure. But what you do, you basically calculate the average capital structure and you unlever your beta, because when you first get your beta from the data, for example, from the Bloomberg terminal, the beta you will get is levered to the capital structure of that particular company. And so what normally people do, what the Modaran does actually, he calculates the average cost of average capital structure, and then he unlevers the beta, and then he again relevers the beta based on the capital structure of the company. Okay, so this is what we do here. And when you look at the capital structure to adopt, basically what you would like to do is you need to take the market capital structure. Okay, why? Because in the long term, your capital structure would tend towards the average, you know, average capital structure within that particular industry. But what I have done, I have looked at the capital structure of RG brands. I looked at the history of the capital structure. I also looked at the other comparable companies and looked at their capital structure, and I found out that, you know, this capital structure, about 40% of equity and about 60%, 50 or 60% of debt is the, you know, market capital structure. Therefore, you know, I assumed that this is the capital structure that the company will, you know, work with in the long term, in the years to come.
Excuse me, could you repeat, how did you, for the equity?
Again, sorry, come again.
Could you repeat, how did you determine the number 41.38% for the equity?
Yeah,
for
sure.
That is okay.
Sure. So here's the calculation I did for the RG brands. So this is the year number, well, 2018. This is 2019, right? Yeah, 1 second, 41. So here is it, right? So we have basically, we have the equity over here, right? I can show you that from the what's it called, from the financial statements. Let's let me go to the actually website. Well, one second, but let me reshare the screen. Okay, do you see my screen, the browser?
Yes.
Yeah.
Yeah, we see.
Let's go to the RG brands. Okay, here is it. So I'll just show you how I found out, you know, firstly, how I got the financial statements and where I took them from, and then I'll show you how I calculated the cost of the capital structure, the share of equity and debt in the capital structure. Okay, then I think I went somewhere here. No. Okay. second, please. Right. Let's try looking over here. All right, I took it from somewhere else. All right, so some companies, they publish their financial statements, their audited financial statements on their websites. Some are not. Sometimes the information is outdated, but where information is updated is, have you ever heard of депозитарий финансовой отчетности?
Yes.
Great. So you can go to this, depository of the financial statements. This is the place where the financial statements for public in Kazakhstan, the financial statements of public companies, the financial statements of companies, of mining companies, basically companies which has licenses to extract something from the earth. It could be water, it could be oil, it could be gas, it could be metals. All those companies, they have you can find their financial statements on this depository of financial statements. Also, there you will be able to find financial statements of finance companies, so banks, leasing companies, microfinance organizations, insurance companies. All those companies have financial statements on this website, and it is very widely used by industry practitioners to find these financial statements. Also the government companies are also by law they have to publish their financial statements on this website. Okay, so there are 4 categories of companies that have to, and which I have mentioned. So let's go to the depository of financial statements. So the link is dfo.kz. So you go over here. You see цифровая платформа министерства. So you депозитарий финансовой отчетности. You can see it over here. So okay, let's move to that. And on this line, you just enter the name of the company, RG brands. Okay, yeah, you see, I took it from here. So let's run the search. The search found the company over here, and so we move there. And you can see there are a lot of information. There are audited statements. There are other sort of information. Okay. Okay, let's move. And it says actually subject предпринимательства малый, although the company seems to be large, right, for us. Auditorские отчеты. Okay, let's move there, and you can see. So the latest audited statements is 2019. So guys, when you will be doing your projects, it is fine to use the 2019 figures, because 2021 figures, 2020 figures, well, you can actually use them as well, but they are a bit off. They're a bit, will seem odd, right, because of the corona crisis. Nevertheless, you can download the audited financial statements, and it says consolidated. So you can open that. From here, you can find the financial statements. Well, it would be great if you go through this document, and normally after the financial statements there are information on the company. So normally, so there is the financial statements, and there are information below that. You can see общая информация, the general information, the information on the structure, the legal structure of the company and its operations, and when it was firstly incorporated and stuff like that, and what kind of brands it produces, and some other history. It is all very useful when you will be doing your analysis. But now we are looking for the balance sheet. Where was that? So here is it, the balance sheet. So you can see that we have our so 2019 is over here. So this is this column. So the capital of the company is 22.5 billion tenge, and you can see that from my from the Excel file. So let me open the Excel file and reshare. Okay. You see my Excel, right?
Yes.
Okay, thanks. So you can see it's also 22.5. So likewise, what you do is you calculate your debt. You basically take the short-term debt and you take the long-term debt, and you add that up. You get the 31, well, almost 32, and you calculate your equity share. How you do that? Well, I did that by basically adding those two, and well, basically taking the debt. In order to get the debt to capital ratio, I divided the total debt by the sum of total debt and the equity, right? So it gave me the 59%, and subtracting from 100, it gives you an equity, right, share. Okay, this is basically how I calculated these percentages. Okay. All right, so where we have stopped, and basically, yeah, as continuing, we have the bets unlevered so we need to relever it to account for additional risk, which is stemming from the fact that the company RG Brands has about 60% of debt on its capital, on its balance sheet. It means that the free cash flow will be more volatile. Okay, we need to account for that. Therefore, we introduced this capital structure into the calculation of beta. Okay, and the last factor is the small size risk premium over here, and it is 2.2 we have. Let's see where I took it from. So as I said, finance professionals, finance scientists, they on a regular basis they calculate what is the premium for investing into the different companies of different size. So investing in larger companies, there are smaller premiums, right? Investing in smaller companies, there are higher premiums because there are higher risk associated. So where I took that from, basically there is a book called Yearbook Valuation something. Well, let's move down and let's have a look. So it says basically, what does it say? So there is a book called Duff and Phelps. Duff and Phelps, they are the publishers of this book, and let me actually show you this book. 1 second, let me open that from in my personal stuff. 1 second. Do you see my screen?
Yes, we see.
Oh, that's too bad.
Valuation handbook.
Yeah, I'm looking for the handbook. Yeah, valuation handbook. Yeah. Let me just find this this book. So where I had it, I think over here somewhere. Duff and Phelps, and it's over here. Okay. So let me reshare the screen. So here is the book. 254. So here is the book, and let me. So here is the book. This is the latest book I found. You know, and they actually produce that on an annual basis. This is the guides to cost of capital, and well, you know, I don't use it as a guidance, but I just take you know, the measures of you know, size premiums, right? So, and it's called and you can, you know, if you ever used you know, the library Genesis, you know, where you can find you know, all the books, you can actually download it from internet, this book. Okay. Right. Okay. So if you you know, look for size premium, right, it will give you, 1 second please, guys. Well, okay, it's 254. So here is it. So it says size premium. So this is the sizes of well, 1 second. So this is the market capitalization, right? This you know, the size by market capitalization, and there is a size premium on that. So if you invest in a company with market capitalization of, for example, 4.3, only 4.3 million or less, then you will have to add a market capitalization, I mean the size premium of 10.9, right? But you know, because you know, again, RG Brands is a private company and its true market capitalization is not available. I took the next table, which you know, measures which calculates the size premium based on the book equity. Okay, and we have the book equity, which was, I think it was at the level of 50 million dollars, and I took the middle of those two. So we have 2.2 not 2.02% and 2.37. So I took 2.2%, okay, as an approximation to the size premium. Okay, so let me go back to our Excel spreadsheet, and I think you can see that screen. So here is it, and I took it from over here. Okay. Okay. So this is where I took the size premium from. And so basically you apply this formula. It's over here. So you have the risk-free. You add your beta, your levered beta, multiplied by your equity risk premium. Okay. And because we are well, normal, I showed you earlier, I told you earlier that we have the country risk premium, right? But I don't add the country risk premium in this particular calculation. Why? Because my bonds, my euro bonds are already, this is the Kazakhstan sovereign euro bonds. So Kazakhstan sovereign euro bonds, they already account for the country default risk. So they already account for the country default spread. They already have it within this you know, number. Therefore, I don't add the country risk premium over here in this calculation. I don't have any company specific risk premiums. Therefore, I just, you know, skip that, and you know, the rest is available in my calculation. Therefore, we come up to this with that number, 9.5. But you know, earlier I have been asked like how you know, incorporate the inflation. You know, this cost of equity is calculated in US dollars. But RG Brands, this is the local company. Its cash flows are in local currency, in tenge. Therefore, you need to convert your cost of equity in US dollars to cost of equity in tenge to account for the currency risk. And it is, super important, the currency risk, especially in Kazakhstan with its, devaluation and, devaluations of the currencies. For example, some of you may already heard that today, actually on Monday, today, the Turkish lira has depreciated 17% just today. So you can imagine that, US dollar investors into Turkish economy, today they have lost 17%. This is huge, right? And if they did not factored in the currency risk, then for sure they will lose this 17% of their investments. Therefore, it is very important to account for the currency risk. And normally, what is currency risk? This is the difference in the inflation rates, basically. So Kazakhstan tenge depreciates in relation to US dollars. Okay. Therefore, there is a formula basically to convert the cost of equity in US dollars to the cost of equity in tenge. So how do you do that? There are two approaches to that. So both of them use the Fisher formula, and the Fisher formula is this one. One second, let me do this. So here is the Fisher formula, okay, and it looks like that. So basically, I think you might have came across this formula from your economics, from your economic courses, or maybe your quantitative courses. So this is basically what he came with through his analysis. So the one approach is to take the inflation rates in Kazakhstan, inflation rates in Russia, or sorry, in the US, and apply this formula to come up with to convert basically the cost of the percentages in the US to the percentages of in local currency. Okay, but there is another approach which I prefer actually, which is not to use the expected inflation, but to use the yields to maturity. So instead of expected inflation, use yields to maturity, and I'll explain you why. So let's first look at the expected inflation, and for your benefit, I did all this analysis just to explain you. So here is the expected long-term expected inflation. So where did I take it from? I took it from the data provider, the Economist Intelligence Unit. This is quite respected, data provider, which is paid data provider. So basically, what I would like to say here, you can see that from 2020, so the Kazakhstan is at the top. Okay, here is the Kazakhstan. So from here, the inflation is falling, right? The inflation rate is falling, and going beyond our inflation rate, comes to the US inflation rate very closely. And to my experience, I never experienced that in reality. If you look at the history, this is the stated inflation, and I think in reality, Kazakhstan has a high inflation. This could be just the formal inflation, that statistical agencies report. But in fact, the inflation is higher, and you can see from the history that it is quite high, and I don't believe that in future the inflation will go down. Okay. Therefore, I don't like taking the expected inflation rates, because it is, to my opinion, it is lower than it will be. Okay. You can see that this inflation in 2020 is 7.5, and it's in 2021. I'm quite sure that inflation will be higher. There are already inflation rates in happening in January, which is higher compared to the previous year data. So therefore, this is why I don't like taking the inflation rate for this particular calculation. Instead of that, as I said, I prefer to take the yields to maturity. Okay. Why? Because I think that what is the yields to maturity? Yields to maturity, basically the debt rates, they normally account for the inflation, for the expected inflation. For example, if you expect a high inflation in future, the bank credit rates will be much higher. Today, bank rates is at the level of about 15%, but if you would, for example, for some reasons, if the expected inflation will be 15, for example, the bank rates, the commercial lending rates will go up. Okay, so the sovereign bond yields, they already account for the inflation, and I think they explain the inflation better than the expected inflation rate, even from the respected agencies. Okay, so what I do, basically, I use the same formula, the Fisher's formula, but instead of taking inflation, I took the yields to maturity. Okay, so yields to maturity of Kazakhstan, or the sovereign yields, basically in US dollars, and in the national currency. Okay. By the way, in terms of the national currency, so where did I take that from? Okay, I took it from, let us see. This is from the CACIE website. Okay, so 9.4, let's find that. So this ticker, it means, I think this is the ticker that tells you that this is the Eurobond, or the currency bond, and we just find this is the maturity dates, okay, here, and we find year 30 or 31. Where is that? So I took it 9.4, 9.4. 1 second. I think I took this one. So 31, you can see over here. So the yield to maturity is 9.4. Let me go to the website and show you, right? So you can do it by yourself. But you need to expect that these numbers could have changed, okay, already, because I did this analysis, week and a half ago, I think. So you go to this link, and we have you press the government securities. You go, I think, you go down. No, not down. Let me. Right, 1 second. All instruments. Okay, so you go to all instruments, and you go to Eurobonds over here. Okay. So this is the Eurobonds. Well, this is the Eurobonds. Okay, but I need the bonds in the local currency. Right. Okay. So. I think I took it from here. 1 second. Yeah, I took it from over here. Let me check 1 second. Sorry, not that one. So here is it. Okay.
So there is a button, if you press like view all, go down.
Right, yeah.
That's it. Yeah.
Okay,
Yes.
right. Thank you very much. Yeah. So you basically take the yields from over here, but as you can see, the yields already changed. So let's find the one I've chosen. So 31. Where was that? So 31. 31. So here is it. See, 9.2. Well, actually, it stays at 9.2 and right. So but it's 9.4. See, so it went down a bit, right? So basically, yeah, you can find the yields to maturity from this website, from Cassia. Okay. Right. So this is how you basically convert the currency. Okay. So now it becomes the cost of equity now for if you were an investor into RG brands, then the cost of equity for you might be at the level of 17.7. I will finish this calculation first, and I move to other approaches, but it would be quicker. But where I would like what I would like to say is, you can see that cost of equity is a bit different. No, you can see there is a slight difference between those two, so it's fine. But there is a huge difference actually. So it's almost 2% difference when using the approach number 3 and approach number 4. And why that happens is, what I think is that you can see the risk-free rate of Kazakhstan sovereign bonds is 1.76. At the same time, the risk-free rate, the yields to maturity of the US 10-year treasury bonds is 1.59. So it means there is a difference of 0.27%, which is huge. This is really, really small. If you remember from the Moderan website that the country risk premium was at the level of 2%, right? So let me move to that. So to make a point that I wanted to. So you can see that the country risk premium for Kazakhstan is at the level of 2.13, right? So he derived it based on the country default spread, which is based on the sovereign country default swaps, which is 0.95. So it means there are 2% spread of investing in Kazakhstan actually. But due to current market conditions, due to the global accommodative policy, global accommodative policy by national banks, by the global national banks, the rates are ultra low. Actually, they are so low that I think for the government it is the best time to borrow today for the Kazakh government, because the rates are so low. So what I would like to say, that I think that this risk-free rate does not reflect the risk of investing in Kazakhstan, in the Kazakhstan securities. And to my opinion, it should be as twice as higher, I mean twice higher. And if we, for example, increase it by 2, and for example, the rate to maturity of Kazakh euro bonds will become from about 2 to about 4, then you should see that our cost of equity is gets even over here. But due to this current national bank monetary policies of very low, historically very low interest rate. In 1980s, the risk-free rate was about 15 in the US. In 2000, it was about 10 to 7%. In 2007, it was 5%. Today, is about 1%, 1.5%. So you can see how interest rates went down today, and I'm not sure what will happen further, but today the cost of the risk-free rate is very low. The yields to maturity of bonds are very low, and because of that, it has its effect on all the countries, on all the on Earth. Therefore, the risk-free rates, the yields to maturity of Kazakh bonds is also went down because of that, I think. Okay. All right. So this is it with cost of equity. Does anyone have any questions so far? No. Okay. So now let's look at the cost of debt. Okay, how to calculate that? Generally, if your company is public company, or it can be private, but if it has some, marketable securities, bonds, what you can do, you can look if the company has existing bonds on its balance sheet. You can look at the rates of that bond. Okay. At the yield to maturity of that bond, if it matches the duration of your project, or generally. What else you can do? You can look at the credit rating of your company, if it has any, or you can calculate, the synthetic credit rating for your company. And I think you have covered that with Alimshan. You can basically try to determine the credit rating for your company, and from credit rating you can determine the cost of debt. But when you are dealing with private companies that operate in the developing world, in the developing countries like Kazakhstan, like Russia, like Brazil, like India, local companies, they don't have access, local private companies, they don't have access to capital markets. Therefore, the only source of debt financing for local companies is commercial banks, And we have the statistics for commercial banks. So what we normally do in Kazakhstan, we just go to the National Bank website, we will find the bulletin, the National Bank's bulletin, which it publishes that bulletin on the monthly rates, and you can find the rates from there. So let's do that together. Okay, so let me reshare the screen again. You see my screen, right? My browser. So what you do, let me close all those windows. Okay, and I'll close this one. So what we do, we go to the National Bank and BRK. Here is the National Bank. Let me open the Russian version. So we go to the statistics. over here. And we go to the статистические издания, statistical, documents. And you can see it says statistical bulletins. Okay, so we go to the latest one, and we can find it there, over here, and we download it. So let's open that. Okay. Right, so this is the statistical bulletin. So what you need to do is you need to find basically the rates for your industry. Okay, so let's go to the content page over here, and what does it say? Кредиты. So loans issued by banks, divided by the industries of the economy, right? With the rates, with ставки вознаграждения. So this is page number 51. So we go to page number 51. So here is it, and you can see. So the industries listed over here. So you can see that what we do, производство продуктов питания, включая напитки и табачные изделия. So we produce beverages. So it means that this is our industry. But you need to understand that there are short-term loans and there are long-term loans. So it depends on what you would like to do with the company. It depends on the composition of your debt. The share of short-term loans, the share of long-term loans, but I'll show you in a minute. But so you can take the short-term loans from over here. It says short-term loans over here, and it says 11.9. Okay, but you can also take, you should also take the long-term. If, for example, there are a lot of if you investing into a project, into an investment project, capital project, if you are doing, then most of your investments will be long-term investments. Therefore, you will take the rates, the long-term loan rates. Okay, and it says this is 13.6. Okay, so from here we take that rates. Let's go back to our calculation, and I will show you the rates. So over here you can see the cost of debt long term 19.6, as I just showed you, and I made the screenshots of that. You can see over here, see 13.6. This is the long term, and this is the short term 11.9. Okay, and when calculating that, I obviously also factored in the tax rate, because interests are tax deductible. Therefore, the company will experience less. Well, this is one of the less cost for debt, and this is one of the advantages of debt. And so I have calculated, you can see RG inputs E18. This is my inputs where I calculated the share of short-term and long-term debt. This is over here. See, this is the share of short-term, and this is the share of long-term debt. And so I applied it to my calculation of cost of debt, and it came to be 10.1. Okay, and so using the WACC formula I calculate what is the cost of capital for this particular company using this approach. Any questions? right? There are, two other approaches. I mean, three other approaches, actually, five other approaches. So, just quickly looking at the approach number 2, instead of taking the risk-free rate of the sovereign bonds in dollars, we can also take that in Kazakh tenge, okay? But the only difference is that you wouldn't need to change the currency, so you wouldn't need to calculate using the Fisher formula. So you just directly calculate the cost of equity in tenge. So the rest is the same. So approach number 3. So what I did over here is that this is 1.59. This is the risk-free rate of the US market, and the rest is the same. Well, first of all, where did I take it from? I took it from, so here is it. This is the Treasury, the US Treasury, and I took it from this website, okay? And let me go to, and again, the rates, I'm sure it have changed already. I took the 10-year bonds. You can see 10-year T-bonds, 159, okay? So let's move to that website. So can you see my screen?
Yes. Yeah, we see.
So again, see, we can take the 10-year bonds. The one I took was 156, right? So this was the one. But now today already it went up, as you can see. So which is now today is 1.74. Why it's going up? Because again, the national bank, the expectations of the inflations of the inflation on the global markets is rising, because there is pent-up demand in the market due to the COVID crisis, and investors, they expect that inflation will rise, because all the saved money will be spent. This is one factor. All the money that people saved and did not spend over over the last year, they will start to spend now, and there will be inflation because of that. And in addition, the US government, for example, they injected about $6 trillion into the economy, distributing money to households, to businesses, or free, plus the base rate went down, right? Which means that companies can borrow money very cheaply and can spend it. Therefore, because of that, the expectations of the inflation is rising, and the risk-free rate is going up because of that. Well, as one of the factors, okay. And obviously, when you will be doing your calculations, your US risk-free rate will be higher. Okay, let's go back. So I took the US risk-free rate, but because this is the US, not Kazakhstan, we need to add the country risks, the spreads of investing into Kazakhstan, and it is 2.1. I already showed you how the model run calculates the country risk premium. Okay. Well, what else? So and the rest is the same. Almost the same. Approach number 4, the difference, where the difference is coming from. Wow, yeah. So the difference is, is stemming from this. I think you can see these two formulas are different. In the first formula, we basically we find the equity risk premium, right? and we multiply it by beta. So in other words, it says that, this is the first formula, but there is second formula which adds to equity risk premium, the country risk premium. And the logic here is that when you invest in a risky industry, which is in a risky country, then your volatility will be even higher. Okay, therefore, this is the logic behind this approach, and it depends on the analysts who does this analysis. Sometimes it depends on which side you are on, whether you are on the buy side when you are doing the transactions or when you are on the sell side. When you are on the sell side, you wanna basically take the lower. You wanna make your WACC lower. When you are on the buy side, you would like to have your WACC higher, obviously. So this is, I think, for your analysis, I never used the approach number 6, right? And for your analysis, if you just focus on these first 4 approaches, it is fine, I think, for you to do that. Plenty of information to find, plenty of analysis to do, and I think, yeah, this will suffice at this stage. Okay.
I have a question.
Yeah, sure.
About approach number 2. So
Yeah.
do we added the inflation to the risk-free rate, or we multiply it?
Yeah, well, basically, the risk, the inflation, you can see the 9.4. This is the risk-free rate. So, and this is the rate of bonds in Kazakh tenge. So inflation is already included in this figure, 9.4.
Oh, okay, gotcha.
Inflation is already accounted for in this number, and you can see there is a big difference, right, between these two. And well, about 7%. So in fact, Kazakhstan's annual inflation is about 9%, or 7% or so annually. So therefore, the inflation rate is accounted for. Okay.
Okay, thank you.
Any other questions, guys? Okay, this is just quick calculations that I did. Just I was interested what would be the.
Also, is it will it be significantly different if I do it? My team does it in the Excel, in the Google spreadsheet instead of Excel spreadsheet.
Well, no, you can, because you are within groups. You can do it in I think you can do it in Google Excel, right? But I never properly use that, and I don't know if your formulas will work there, right? So please, it's up to you. It doesn't matter where you would do that. The most important stuff is that you understand how, all the members of the groups will understand how the calculations is done and what is the background behind every digit. What are the fundamentals? Why, the beta is lower than one, why the beta is higher than 1. This is the most important stuff. And when you will be, presenting your calculations and your results, the key thing that you need to explain as a team to Animshan and to me, why you took this particular number, why you think it is appropriate. But I will, I think I will write a small instructions to you later today, just as a quick guide. I think generally this Excel file is a good guide for you to do the analysis, but just to manage your expectations and manage our expectations on the results we are looking for, I will provide these instructions. But so, answering your question, it's up to you guys. How would you like to do your work? You can do it, by hand if you would like. It's up to you. Okay, but just you need to show us how you did the calculations and the numbers and stuff like that.
Also, shall we have the same sort of sheets open in the file, like betas, RG inputs, sources, references?
No, not necessarily, no.
Okay, just this sort of information that presented on this sheet, right? The main one.
Yeah.
Okay, thank you for your time.
Yeah, no problem. Well, this is only the first part, but this is most time-consuming part. Guys, so as I said at the beginning, I also wanted to look at the debt capacity, right, of the company. Again, going to the basics of corporate finance, the key objective of corporate finance is to maximize the firm value, right? And the firm value is maximized when your cost of capital is minimized. When it is the lowest, at that point your cost of your firm value will be highest. Therefore, basically, what corporate finance directors, right, what they are constantly trying to do, they are looking for optimal capital structure, because at optimal capital structure your cost of capital will be the lowest. Okay, and so why it happens? Because with higher level of debt, and as you know, the debt is cheaper than equity. Therefore, having a little bit of debt on the safe level will yield a lower cost of capital. Okay. So right, let's look over here. So I would like you to do this sort of analysis as well. So what I did over here, I calculated the cost of equity. Well, generally I did for all the approaches, but you may actually do that for only first 4 approaches. Just for you to understand that at the different debt to equity, debt to capital ratios, at the different, debt levels, your cost of equity will be different. Why? Because your capital structure affects the beta, right? So you can see the beta levered, and it actually goes up. See, from 0.55, as you remember, this is the figure that we took from the Moderan website, and it goes up because the debt level is rising. Okay. So this is one, but at the same time, because cost of debt is lower, is cheaper than cost of equity, having a little bit of debt is good for the cost of capital of the company. So the logic behind it is that with lower cost of capital, you will basically pay less dividends. Therefore, the money will remain in company, so it will allow you to develop the company and increase its capitalization. So if you can do this analysis just to understand how the different debt levels affect the cost of equity. And then after that, you can use basically this spreadsheet, this table to do your own analysis. Sorry, it's a bit lagging. Yeah, 1 second. Yeah. Well, basically, when you operate in Kazakhstan, it is actually quite difficult to reach or to actually maintain the optimal capital structure. Why? Because we don't have a easy access to capital markets. When you take so because we don't have access to capital markets, it means that the only source of debt in Kazakhstan are banks, is a bank debt, is commercial bank debt. So what is commercial bank debt? Banks require that you amortize your debt on the annual basis. So for example, you take 100 tenge debt, right? So with the maturity to mature in 5 years, it means that every year you need to repay the principal of 20 tenge. Okay, so every year 20, 20, 20. Okay, up until the end of the maturity. While in the developed world, for example, in the US, you don't have to do that. If you attracted your debt from capital markets. So basically what happens there, you borrow a particular amount of debt and you only repay the principal at the end of the maturity. For example, if you took in the US on the capital markets, you took 100 tenge, you would need to repay this 100 tenge only in 5 years. So you would need to amortize it on a yearly basis. But what happens, what companies do, they basically they refinance at the end of year 5, they refinance that debt. Therefore, it allows them to maintain a constant level of debt, which is, so they basically what they do, they reach a certain optimal level of debt, which they think is safe for their company, and then they maintain that level of debt. And the only outflows will be the interest that they pay on that debt. So they never basically, large mature companies, they never repay that debt. They don't take it out from their balance sheet. Okay. In Kazakhstan, it's impossible to. Basically, banks require you to amortize debt on an annual basis, and you cannot refinance it on a yearly basis because it would be too costly for you, because in the loan contracts there is a term that require you to pay a certain fee for early repayments. Okay, so because of that it gets costly. Therefore, in this analysis, let's just imagine that you have certain capital structure, and let's imagine that within that capital structure, your level of debt is 10%. So you can calculate that, right? So 10% times the capital, which is over here. Okay, so this is the capital. So this is equity plus total debt. Okay, this is the total capital. And so we multiply it by 10, imagining that, if RG Brands had only 10% of debt, what would happen, right? And we do the analysis. But, in Kazakhstan, basically, in order to understand what is the optimal level of debt, you can look at the ratio which is called net debt to EBITDA. Have you came across that ratio, guys? Right. So basically, guys, EBITDA. This is, as you know, I'm sure this is the operating cash flow. Okay. Obviously, before expenses on the working capital and on the cost of on capex. But this is EBITDA is a good approximation on your operating cash flow that is directly linked with core business. And this ratio, it just tells you how many years the company will be repaying the principal amount of debt. And there is in corporate finance, there is a rule of thumb that says that your net debt to EBITDA should not exceed 3.5. It should not be higher than 3.5. But to be honest, in Kazakhstan, when you need to, not only in Kazakhstan, obviously in other developing countries, or when you deal with companies with mostly commercial bank debt, because you need to repay the principal amounts on an annual basis, your net debt to EBITDA should be lower. And you can see from this calculation that our net debt to EBITDA, the current net debt to EBITDA of a company is 2.5. And you can see that actually the company can have a higher, the debt levels up to 80%, right? Not actually up to 80, but up to 70%, because as you can see from here, the after debt cash flow goes down to this amount only, and on the level of 80%, level of debt of 80%, our cash flows goes to minus. Okay, but the current level of debt at RG Brands, I think this is optimal. Why? Because we have this EBITDA over here calculated, and you can see how I calculate the EBITDA from over here. You can do your own analysis. So basically, I took the, where is that? So I took the EBIT, which is operating profit from the income statement, and I added the amortization. Okay. This is also I took it from the cash flow statement. So this is how I calculate EBITDA. So, when you do the analysis, when you analyze companies, you always need to stress test your cash flows, saying that, let's imagine, what if EBITDA goes down 20%? If it goes down to 20%, so let's see what happens. Goes down to 20%, so 0.0 times 0.8. So our EBITDA becomes, 1 second, it becomes 9 billion. So at 9 billion with 60%, 60% of the level of debt, our principal payments plus the interest payment will be at the level of 9.8 billion. So it's already exceeding, when stress testing, our, principal and interest repayments already exceeds the available cash, operating cash. Therefore, it would not be wise for a company to get a higher debt levels. Therefore, RG Brands have an optimal capital structure today. I said earlier that in corporate finance there is a rule of thumb that net debt to EBITDA should not exceed 3.5 for the company to stay safe. But in Kazakhstan, again, I think it should be lower because of the higher volatility in the markets, and because of the because of the fact that you need to carry out the debt repayments on an annual basis. And so therefore, to my experience, the net debt to EBITDA 2.5 for a private company in Kazakhstan, so the company should not have this ratio higher than 2.5. This is to my experience. And when you will be doing your projects, I would like you to, tell me and tell Alimshan your, your explanation and your thinking in terms of whether this particular company has an optimal capital structure, whether it should be lower, whether it should be higher, whether it should stay at the same level. All right, and so, and I completed that with the WACC calculation. So we have cost of equity calculation, we have the cost of debt calculation on the previous page over here, and normally banks, the banks don't change the rate. They either tell you, they can provide you with debt or not, but they don't, often change their rates. So bank debts normally they are quite fixed. And so I do this kind of this calculation, and you can see that WACC goes. You can see that the WACC goes up slightly over here. So it goes up with that approach, it goes down with that approach, right? I need to check whether that calculation is in fact correct. Goes up. Anyway, so you can see that, well, looking at the approach number 2, you can see that our cost of WACC, cost of capital goes down. You can see it from over here as well, and I'm not sure what's happening over here, but I'll check it later on. Okay, so you can see that optimal capital, having a certain level of debt, provides you with, you reduce basically your cost of capital when having a certain level of debt. Well, that's it. Do you have, guys, any questions? Again, it's a shame we don't have. I don't see your faces and your eyes. It is a bit, not very comfortable to, explain it to yourself just looking into the, screen, onto the screen. Another point, I think, just for a perspective to understand. So you can see from over here that the cost of debt is about 13 and 12% for the short term. But in fact, due to a number of state programs that subsidize the rates, it is well possible that RG brands cost of debt is much lower, at the level of, say, 6%. Why? Because the cost of debt when you go through the state programs from DAMU, for example, is at the level of 6 to 8% currently. Okay, but for just to be on the conservative side, I didn't take that into account. You could do that for yourself if you would like to, but in order to do that, you need to do a little bit of study of that programs, because not all the sectors, not all the industries are being subsidized by the government. So the production sector, the manufacturing sector, this is the industries that are subsidized by the government. And so, agriculture, for example, is being subsidized. It is the industry that, is being subsidized in all the countries in the world. Because, in that industry, the margins is the profit margins is very low. Therefore, it is being subsidized. But trade, for example, is not subsidized in Kazakhstan. The retail trade businesses and wholesale trade businesses, they are not subsidized in Kazakhstan. Obviously, there are exceptions always. Any questions, guys, on this calculation? Well, I think that this is it. what next I will do. I will get the companies for each of the group, where you will need to do the cost of capital calculation using the 4 approaches. You will need to take the updated versions of this calculation, and you would need to show your thinking, your understanding of every digit. And then you will need to, as a second part of your project, you will need to do this analysis and tell us whether you think that the capital structure of this company is, to your opinion, is at the optimal level or not. Okay, and again, as I said, I will provide you with the list of companies assigned to every group, and I will provide you a little guidance to ease your calculations.
So should we provide definition after each calculation, or in presentation?
After each what do you mean definition?
Like our understanding, how you said. In the
It's up to you. You can write some notes on your presentations, on your PowerPoint presentations, or you can just talk us through just verbally. It is up to you.
How long should the presentations be, if you mind?
It is expected that it will last 10 minutes, about per group.
Okay, thank you.
So basically, you would need to make a little bit of rehearsal before that, to be able to, to fit into this 10 minutes. This is important, why we are doing this project, because, when you go to the markets, everything you do within groups, and it is important to, to be able to present your ideas. Okay.
Thank you so much, Talgat, for your presentation, and it was really so practical. And I'm sure everybody got some benefits from this presentation. And I'm going to put this on Moodle, and instructions that will be given from the Talgat, I'll put it on Moodle where you can have an access. I guess it will be ready for today. Yes, Talgat will be able to provide this instruction for today.
Yeah, I think so. Throughout the day, I will provide it. Till
With
the end of
company names, yeah?
Yeah, company names and instructions.
Okay. Thank you so much. We really appreciate. And thank you for you all that you had attended our class during the holiday. Thank you so much. I wish you happy Nowruz again.
Thank you very much.
And on Wednesday, you're going to tell me the time as well when we will be able to meet you, like Wednesday anytime. I mean, if the students have any questions or something. I think we lost connection with Talgat.
There is no attendance, right?
No, there is no attendance because somebody had a class today, somebody had some other issues. But today you had to just, I will put it on Moodle today, where you can have an access.
Right.
And Talgat, we lost you for a couple of minutes.
Hearing you, but now it's I reconnected back.
Okay. Would it be possible for you to share the convenient time with us, like when you will be available on Wednesday, so that we get in touch?
Yeah, sure. Let me check my calendar, and let's. I think let's set the dates and the timing now. So I think 10 a.m. would be good as well.
So Wednesday, 10 a.m. Yes.
Yeah.
Okay.
So I'll be happy to answer your questions, guys. Any questions that you would feel appropriate to ask, whether practical or theoretical, well, generally. Then additional comment on the, second part of the calculation, the ratio net debt to EBITDA. This is, the widely used ratio. Whenever I work with, Russian banks like, Sberbank, VTB, for example, Gazprom Bank, when they provide the term sheets for our transactions, I always see this, ratio, the net debt to EBITDA, and they have certain, benchmark. So they, if again, it exceeds a certain benchmark at the level of 3.5, they don't, finance projects. If, the net debt to EBITDA of that company exceeds this ratio, this number. Therefore, when you in future will be analyzing the companies for yourself, and you will try to understand, and when you will be trying to understand whether that company is, over leveraged or under leveraged, you can just look at this ratio, very quickly, and look at the cash flows and look at the debt level. It will give you a good approximation whether a company is, leveraged or under leveraged.
Thank you so much for the session, Talman.
Yeah, no problem.
Okay, if you got any question, please feel free to ask. If not, we'll have to stop in here. Thank you all again, and see you on Wednesday.
Yeah.
Goodbye.
Thank you.
Bye.
Thank you. Goodbye.
Happy holidays.
Happy
Thank you.
holidays.
Thank you.
very
Same to you
much.
all.
Goodbye.
Thank you. Goodbye.
Bye.
Goodbye,
Bye. Take
Professor.
care, guys. Take care.